Welcome to the Daily Brief, where I'll go over the highlights in the market for Wednesday, August 31st, and then briefly discuss the highlights for Thursday, September 1st, and happy new month day. I will not be posting a full-length video for Thursday. There was not an awful lot of change technically. Yes, we're turning more negative. Yes, the market is becoming more short-term oversold, but there wasn't a really big change. And those changes that did happen, I'll point out here just in the text that I'll talk about. But things are just not looking very good right now, but there might be a couple of things that we can latch on to. Number one, that the market is oversold on a short-term basis, so that might produce some kind of a bounce. Another one is September 1st, that's the first trading day of the month. Sometimes we see an inflow of funds coming into the market at the beginning of the month, and that usually is to buy. So that could produce some kind of a support or a little bit of a bounce as well. But overall, we're still looking negative across the board. So let's go back and talk about what happened on Wednesday at the open. We did have a slightly higher open. It looked like, okay, maybe we're going to get a bit of a bounce here. That really didn't last. Prices quickly fell down to the unchanged level. So even though we had a positive open, we fell back. And then we spent most of the day just bouncing above and below the unchanged level. As the day went on, we saw selling increase, but we never even made it down to S1 at 39.55. So it was a lot more subdued. And that's when I decided, I don't think I'm going to do a full-blown video because we're not seeing an awful lot of price movement in Wednesday's session. Going into the close, we closed right at the lows. That's a little bit more negative too, when that always happens. We ended up being down 0.78%. Again, a little bit less than what we've been seeing. Volume was actually above average because it was the last trading day of the month. So you have a lot of these mutual funds and hedge funds and money managers that need to shore up things for their end of the month statements that will be coming out. So that's probably why we saw a real pickup in volume. It might drop back down over the next few days. The technicals are still quite negative overall. Everything is pretty much pointing down except for sentiment. That is still neutral right now, and that is a concern. Of course, we have inflation and interest rates and growth concerns. That's what the markets are fixated on now. As I've been saying in the videos, 2 times now, the market has developed this idea that maybe inflation has topped out. And we even have some economists like Edward Yardeni. He thinks that inflation may have topped out. And so the market usually latches onto that and sees it coming down with the idea that the Fed will then start to become more dovish. Well, that's not what the Fed is doing. And that's why we're seeing these nice little bounces. We get at the point of decision. The Fed comes out and says, no, that's not what we're going to do. We're going to keep fighting inflation. And so then we end up turning and going back down. We do have the whole list of geopolitical concerns, but really, from the stock market perspective, it's inflation and interest rates that are still the main focus. Earnings are being released company by company. We have the debate going back and forth. It's not as intense right now. We're mostly talking about interest rates, where the recession debate, it's like, okay, we'll argue about that another time. You still hear people talking about it, but as time goes on, it's like, okay, things are just not very good right now, whether we're in a recession or we're not. And then we did have some Fed speak come out that I'll address here in just a moment. So what are some comments that we can make? Selling continues as support has been broken. The small caps, yeah, they gave up the support. This is what I pointed out in yesterday's video. And the Wilshire, yeah, it gave up its support. We still have one index that is still a little bit above its support, and that's the mid caps. Okay, can we put our whole hope on a bounce on the mid cap index? Not generally a real catalyst to send things higher, but at least it's hanging in there. And technically, it's still looking about the best as far as all the other indexes. They all look bad, but the mid cap looks the least bad right now. The S&P has become short-term oversold. With all this dropping, all of our indicators, our short-term indicators anyway, they're getting to extreme negative. Doesn't mean they can't still go down even more, but we're in that area where a lot of times selling will have a tendency on a short-term basis to exhaust itself. Now, we haven't really hit oversold with intermediate and long-term, so that suggests that we might have some more room to go to the downside. But for right now, on just a short term, 1, 2, 3, 4, 5 day basis, we have become oversold. All of our scenarios are on hold right now. So we're not really talking about them because we need to see follow through and price action for those scenarios to actually be justified. Oil did close below 90. That might give a little bit of support to the market if we still see oil prices decline, because that's what's causing a lot of the growth concerns, that oil is so high. And then we have to keep asking this question: will prices fall to the June low? Is that even going to happen? We're still well above that right now, but are we going to go all the way down to that level? What's going to happen if we do? Are we going to go down there and bounce? Are we going to go down there and just keep going down even more than that? Nothing that we necessarily need to answer right now, because we can't answer that. Of course, a lot of people have their opinions and they think they got this all figured out, but this is just a question that we need to be asking and keeping in the back of our mind as each day unfolds. And we have a new addition to our inverted yield curve list. The 30-year to the 5-year has now gone inverted as well. So we not only have that new one, we have the 10 to the 2-year and the 10 to the 5-year. So we have 3 of the more major yield curves that are now inverted, where we had been just seeing just two. I mean, the fact that any of them are inverted just shows you that things are not right in the economy. Interest rates, the US dollar and oil, they still have a pretty strong inverse correlation to stocks, where they're shifting around a little bit. But the idea is you watch interest rates, the dollar and oil, and if they're going down, that might give some support to stocks. Now, we saw a little bit of a decline in the dollar and stocks on the same day. It doesn't mean that these relationships are always a direct one-to-one or one-to-inverse-one relationship, but we just want to keep an eye on this, and that's why we study intermarket analysis, because sometimes this can give us some clues as to what is happening. This is, to me, the concern right now. We're right in the neutral range with our fear and greed index. We're not tipping over into fear at all yet, even though we still are seeing declines. And then these are some of the comments that came out from the Cleveland Fed President Mester, who's a voter on the FOMC. She said that she thinks the Fed funds rate will be somewhat above 4% by early next year, and it looks like we're headed in that direction, and that she does not anticipate a rate cut in 2023. Now, this is not the chairman. This is just a person, but this is a person with a vote. So this is more hawkish type statements that are coming out of the Fed. Then she also added, this will be painful in the near term, but so is high inflation. That's to kind of justify being able to keep raising interest rates. So this is more hawkish speak that is coming out. As far as the economic reports that came out on Wednesday, we had the mortgage applications index that comes out every week. It declined 3.7%, and we've been seeing that over and over. Even though housing prices are going up, they're getting to the point where people can't afford them. Interest rates are going up. Now people are looking at they're having much higher monthly payments if they do buy a house. And so people are starting to not apply for mortgages. The ADP employment change report, this comes out usually 2 days before the employment situation report, and it estimated, and sometimes these numbers are way different from what we'll be getting out on Friday. Sometimes they're more in line with each other. Apparently they've changed how they do the ADP employment report here. They've revised their methodology, but they say that there's been 132,000 employees added, or you could say new jobs that were added to private sector payrolls. So we're going up, there's more jobs being added, But that's not really been the problem, at least yet. It may become the problem in the future with employment, but right now, that's one of the reasons why people are saying we're not necessarily in a recession, because look at the employment. There's more jobs out there than people to fill them, and people that desire to get a job currently. Also, the Chicago PMI, which is more regional, more there in the Midwest, the reading was at 52.2. It's lower than expected, where they expected it to come in at 53.1. So that was a little bit weaker. Our trend, it's still negative, and the ADX continues to fall, but that red line is rising kind of fast. And if we see some more downward movement, especially with a lot of price action, that could start to turn up and possibly go above the moving average. And if that happens, that would continue to be a strengthening negative trend. Our bias is still negative because we had the down day, and our last number of days, that's how I measure momentum, that is also negative overall. So what's our outlook? The technicals are negative. Can't really dispute that. They're losing support. We still have that one mid cap index out there, but we're showing an oversold condition in the short term. We have jobless claims coming out, and they come out every week. We have revised second quarter productivity, as well as the second quarter unit labor costs. That'll be coming out. So how productive are companies being, and how much is it costing them to produce things? And then we have the final IHS market manufacturing PMI. This is not a real biggie, but we do have another one that's coming up here that is a big one. And we have construction spending coming out, and then this one. That's why I've highlighted it in gold. We have the ISM manufacturing index, and that's a big report, and that might be a real influential report in Thursday's session. We have the whole list of geopolitical events with inflation and interest rates, again, still being the one that the markets are really focused on. Starting to hear some problems coming out of China with their economy. We'll just have to see how all that plays out. That doesn't necessarily have a real impact. We need to be watching Europe and what's going on in Europe, and they're starting to really have some problems as well, because they a lot of times will lead the way before things happen in the US. And then any more Fed speak that possibly could come out. So what's our scenario? We have to go with the down scenario for all the reasons that are listed right here. There's a lot of headwinds that the market is really fighting against. The technicals, they're negative. We're losing support, but you might want to at least delay a little bit if you're looking to go short, because we have become short-term oversold. We can't really justify a positive scenario other than the fact that we are short-term oversold. Our scenarios, we just kind of have to put those off to the side, like we've been doing the last few days. The technicals, we can't really look at those as telling us anything positive. And we're losing more of the moving averages, and the longer we stay below those moving averages, the worse the moving, they might start to turn down as well. And we can't really say that we're sideways, although the ADX is declining. But if we see some strong movement, that ADX is going to turn and go back up. So we're still above 20, and the red line's on top, so we are still negative. So our conclusion, we have to say overall the S&P is negative, short-term negative, but oversold. Intermediate term and long term, we continue to be negative overall as well. So thank you. Again, this will be the only video that I'll post for Thursday's session. Have a great day. I'll evaluate things after Thursday to see if I'm going to do a full-blown video. I will definitely do one after Friday, because we have the employment report coming out. So, and that I want to be able to address that, but that'll be prepared over the weekend. So have a great day, and I will talk to you next time.